Life insurance, or life assurance, especially in the Commonwealth, is a contract between an insurance policyholder and an insurer or assurer, where the insurer promises to pay a designated beneficiary a sum of money, the benefit, in exchange for a premium, upon the death of an insured person, often the policyholder. Depending on the contract, other events such as terminal illness or critical illness can also trigger payment. The policyholder typically pays a premium, either regularly or as one lump sum. Other expenses, such as funeral expenses, can also be included in the benefits. Life policies are legal contracts, and the terms of the contract describe the limitations of the insured events. Specific exclusions are often written into the contract to limit the liability of the insurer. Common examples are claims relating to suicide, fraud, war, riot, and civil commotion. Life-based contracts tend to fall into two major categories. Protection policies, designed to provide a benefit, typically a lump sum payment, in the event of specified event. A common form of a protection policy design is term insurance. Investment policies, where the main objective is to facilitate the growth of capital by regular or single premiums. Common forms, in the U.S., are whole life, universal life, and variable life policies. An early form of life insurance dates to ancient Rome. Burial clubs covered the cost of members' funeral expenses and assisted survivors financially. The first company to offer life insurance in modern times was the Amicable Society for a Perpetual Assurance Office, founded in London in 1706 by William Talbot and Sir Thomas Allen. Each member made an annual payment per share on 1 to 3 shares, with consideration to age of the members being 12 to 55. At the end of the year, a portion of the amicable contribution was divided among the wives and children of deceased members, in proportion to the amount of shares the heirs owned. The Amicable Society started with 2,000 members. The first life table was written by Edmund Halley in 1693, but it was only in the 1750s that the necessary mathematical and statistical tools were in place for the development of modern life insurance. James Dodson, a mathematician and actuary, tried to establish a new company aimed at correctly offsetting the risks of long-term life assurance policies, after being refused admission to the Amicable Life Assurance Society because of his advanced age. He was unsuccessful in his attempts at procuring a charter from the government. His disciple, Edward Rowe Moraes, was able to establish the Society for Equitable Assurances on Lives and Survivorship in 1762. It was the world's first mutual insurer, and it pioneered age-based premiums based on mortality rate, laying the framework for scientific insurance practice and development and the basis of modern life assurance upon which all life assurance schemes were subsequently based. Moraes also gave the name actuary to the chief official, the earliest known reference to the position as a business concern. The first modern actuary was William Morgan, who served from 1775 to 1830. In 1770,